You're watching Ask the Institute, presented by the Options Institute at CBOE.
Welcome to Ask the Institute, where we explore the topics you want to know about. I'm Michelle Kaufman, Market Observer with the Options Institute, the Education Division of the Chicago Board Options Exchange. Today's question comes to us from Monica in Roseville, California. Monica wants to know about the components of an options price. She asks, can you please explain the terms intrinsic value, time value, and parity? Well, Monica, I think the best way to address your question about the components of an options price is to start with a simple example. Let's consider an example where the stock price is at 56 and the strike call is trading at $8 per share, just like the graph demonstrated here. As you see in the graph, the vertical bar represents the options price. As you'll also note, there are two parts to this bar: the bar above the stock price of 56 and the part below it. Let's start off by talking about the bar below the stock price at 56. This part below the bar indicates the option's intrinsic value, which is the difference between 50 and 56. Remember, a call option is the right to buy the stock at 50. If an investor were to exercise the call, thus buying the stock at 50 per share, and then immediately selling the stock at the stock exchange for $56 per share, then the investor would realize $6 of intrinsic value, also referred to as real value or in the money. Again, looking at the graph, the portion above the bar is the portion of the options price in excess of intrinsic value, which is $2 per share in this example. This is what is known as time value. Note that the intrinsic value of the $6 per share and the time value of $2 add up to the total option price of $8 per share. Now let's look at an out-of-the-money call. For the stock price still at $56, the 60 strike call is $4 out of the money, and let's assume it is trading at $1 per share. In this case, an investor would prefer to buy the stock at the stock exchange at its current price of $56, rather than exercise the 60 strike and buy the stock at $60 per share. This is why the call is considered out of the money, meaning that it has no intrinsic value, and as a result, all of the options' dollar premium is time value. Now you're probably asking, why do options have time value? Well, in previous segments, we've discussed how options are similar to insurance policies. It is the time value of the option that is similar to the insurance premium. And just like insurance premiums, they can be higher or lower based on the value of the asset being insured, the length of the policy, or the riskiness of the asset. So do options, time premiums, have various things based on the stock price, the time to expiration, and the volatility of the underlying stock. Now imagine a scenario where we have a stock trading at a price of $39 per share and a 30 strike call trading at $9 per share. So in this example, we have $9 of intrinsic value and $0 of time value. No option price in excess of intrinsic value. Such an option is said to be trading at parity. Now the term parity means equal to. If this scenario were to exist, an investor would be indifferent to buying the stock at $39 versus buying the 30 strike call for $9 and exercising it, assuming no commissions, of course. Now, if you would like to learn more about the components of an options price, including intrinsic and time value, visit our seminar and events page for more information on our premier educational program, Options Institute Plus, and the Options Initiative Seminar at the address listed below. Well, just like our last example, this is Michelle Kaufman, Market Observer at the Options Institute, with $0 in time value left, exploring the topics that you want to know about.